All right, it's final. The Fed is absolutely trying to destroy the stock market and destroy financial assets and destroy the economy and destroy the job market. They just raised rates. Again, the Fed funds rate is now above 5%. We went from 1 year ago, about 13 months ago, a 0% interest rate from the Fed, which determines all the other interest rates in the market, determines how expensive debt is, to a 5% rate in a matter of 13 months. Absolutely ridiculous. Anyway, we're gonna get into all that today and the crazy ramifications of it. First, thank you for being here. If you're subscribed already, I appreciate you. If you're not subscribed, go ahead and hit that subscribe button. We're at like 130 subscribers, on the way to 200. Can't wait to hit that number. It's been an awesome journey and I'm glad you're here for it. As a thank you for doing that, my two cats are right off camera, right there and right there. There's Luna and there's Millie. I'm gonna put pictures on the screen. They're super sweet. They thank you for subscribing. They appreciate it. All right, let's get into this video. So the Fed is definitely trying to crash the market. Yesterday was Wednesday, May 3rd. They had a meeting. I was hoping that they were gonna say, hey, we have stopped raising rates. We're gonna pause and we're gonna chill. No, they raised by another quarter point, which is 0.25%. So that brings us between a range of 5 and 5.25% for the federal funds rate. Why this matters is it means that all debt is more expensive in the capital markets. So not just debt for you and me as someone who might want to get a mortgage or someone who might have credit card debt, which that's an unfortunate situation, someone who wants an auto loan, any type of debt, someone who wants a business loan. Okay, all those types of debt are more expensive, but also this makes debt more expensive for companies, like companies that are traded in the stock market. The stock market has been in a very, very unfortunate down spiral. We had a nice up for the first few months of the year. Now we're going back down, little double dip type deal. But the Fed is trying to cause a recession so badly. That's all they want. We saw inflation like at super highs throughout 2021, and they kept saying, oh, it's transitory, oh, it's transitory, oh, it's transitory, meaning it's here today, gone tomorrow. Everyone, literally like all people except for the Fed, were saying it's not transitory. You got to do something right now before this gets out of control. And then inflation just kept going. Hit like a 40-year high or something. Ridiculous, disgusting. So then they were like, oh, you guys were right. It wasn't transitory. We're going to start raising rates and we're going to raise them aggressively. The reason they had to do it so aggressively is because they waited so dang long to raise in the first place, which is ridiculous. You got to pour a little cool water on that inflation monster that keeps rearing its head once we see it. They didn't do that. They just kept rates at zero, debt was cheap, stock market was soaring, all financial assets were soaring, real estate was soaring. And now we're having this big bust as a result of them raising 5% in a matter of 13 months. So kind of ridiculous. They also, I don't think they're gonna stop until they see the labor market just totally crumble. Like they wanna see new job creations go down month in, month out, quarter in, quarter out, for them to feel happy like they did their job. Like the story, I feel like it changed from them wanting to get inflation under control, which it's slowly moving down, to them wanting to get unemployment high or the labor market bad. You know, they want the labor market to be terrible so they can say, okay, we did our job, we destroyed the economy, and now we can lower rates. Meanwhile, while they're doing this, banks are failing left and right. They bought these treasury notes at these low yields, and then yields go up, the price of the treasuries go down, they have to liquidate at a huge loss. So SVB, Silicon Valley Bank, was the first one that went under. First Republic Bank went under, and it looks like PacWest is gonna go under. I just hope this contagion does not spread through the financial markets in a crazy way. Like if something like SoFi, like a fintech that's just recently become a bank through Golden Pacific Bancorp, if they start to go under, oh my God, I'm gonna be in trouble. Okay, I own SoFi shares. I don't want that to happen. So all the lenders are having a tough time. All the asset managers are having a tough time. All the banks are having a tough time. And like, I just wonder what would have to happen in the financial markets in order for the Fed to say, okay, we've gone too far, too fast, we raised too aggressively, people weren't ready for it, and now we gotta cut rates. Like, would it have to be like Wells Fargo going under? Or would it have to be like JP Morgan going under? One of these huge big dogs, Bank of America? I seriously doubt that's gonna happen. So, I don't know. I'm really hoping that they're going to pause the rate hikes. They're going to leave us at the 5.25 probably throughout the summer and then start to cut in the fall. That would be my hope. That's going to be a very good thing for the economy and for the stock market and for the real estate market if they're able to start to cut rates in the fall. All right, having these elevated rates is not good for anybody. It makes money very expensive. Yes, I understand that inflation is a bad thing. And yes, I understand that we need to get it under control. But I also understand that the Fed is like your friend that shows up to the party 2 hours late, 3 hours late, and then overstays their welcome by 2 or 3 hours as well. So it's like they were late to the party whenever it was time to raise rates. They were like, 3 months late, 6 months late, 7 months late, 9 months late. And now they're raising rates when they shouldn't be raising rates anymore, in my opinion. It seems like the stress on the market is absolutely working. Chill out for a little bit, let everyone get their bearings, stop raising rates, okay? And the Fed has overstayed their welcome. They came to the party late, they stayed at the party for way too long. That's classic Fed move. They do this every single time, all of the times that they do anything. It's terrible. They're looking at lagging indicators, so all their data is terrible. The CPI is trash. We don't need to get into all that, but anyway. How does this matter to you? I think it's important to double check any stocks that you own, any individual stocks that you own. Make sure no one is debt loaded. Anyone that's debt loaded is having to pay so much money just to service their debt in these times where the Fed has the rates between 5 and 5.25. That's very expensive, especially when you compare it to 0% rates that we were sitting at, where a lot of these companies took this debt, okay? So go ahead and maybe trim your positions in things that are debt loaded, or just get out of those stocks completely. If you have a little gain, take your gain. If you have a little loss, maybe take your loss. Get into something that has a low amount of debt, a lot of assets, a lot of cash on hand, a lot of short-term investments on hand, so that they can weather the storm of the unfortunate times that the Fed is causing. All right, that would be a good decision. Also, you as an individual, go ahead and be a little risk averse. Don't be taking out new debt right now with these crazy high interest rates, and keep cash around. Okay, it's really, really important to keep cash around so that in the event that the market goes absolutely ballistic to the downside in a bad way, you can take advantage of deals out there. Even if you bare minimum, you just go ahead and buy the S&P. If the S&P drops by a ton, you have a little cash on the sideline, you can buy the S&P, you can average in over time. Just make sure your cash loaded, you got your emergency fund ready to go, you're not holding credit card debt, etc. All right, those would be my specific actionable things. Past that, there's really nothing you can do. You can't control the Fed, you can't control the stock market, but make sure you're ready. You're in a position of power. You have more income than expenses on a regular basis. You're cash loaded. You don't have a lot of debt, and you're not taking out new debt right now. All right, keeping it short and simple. I appreciate you for being here. If you made it this far, go ahead and subscribe. Thank you so much. Have a great day.